Have you ever wished your money could work for you? Imagine if every dollar you saved could multiply on its own, creating more wealth without you having to lift a finger. Imagine your savings growing, even while you sleep. Picture waking up each morning knowing that your money has been busy working hard for you, steadily increasing in value. That's the power of investing. It's not just about putting money aside, it's about making your money work smarter, not harder. It's like planting a seed that grows into a strong tree, giving you shade and fruit for years to come. Just as a tree needs time and care to grow, so does your investment. In this 5-part series, we'll learn how to start investing, even with a little money. You don't need a fortune to begin. You just need the right knowledge and a willingness to start. This first part is about taking that first step. It's about overcoming the fear and uncertainty that often holds us back. We'll cover the basics so you feel ready to plant your money seeds and watch them grow. From understanding different types of investments to knowing how to diversify your portfolio, we'll guide you through it all. No more waiting on the sidelines. It's time to take action and make your money work for you. It's time to take control of your money and start building a brighter future. Whether you're saving for a home, your children's education, or your retirement, investing can help you reach your goals. This isn't about getting rich quick. It's about making smart, informed decisions that will pay off in the long run. Investing is a slow and steady journey. It's about patience, persistence, and making the right choices over time. But it's the surest way to build real wealth over time. With each passing day, your investments can grow, bringing you closer to financial freedom. So, are you ready to become an investor? Let's get started. Together, we'll embark on this journey to grow your money and secure your financial future. Why is investing so important? It's a question many people ask, especially when they are just starting to think about their financial future. Think of it like this. Imagine you have a job where you work hard every single day, putting in long hours and effort to earn your paycheck. You work hard for your money, right? But what if your money could also work hard for you, even while you sleep or enjoy your free time? Investing helps your money work hard for you. It's like planting a seed and watching it grow into a tree that bears fruit year after year. When you invest, you buy a small piece of something that you hope will grow in value. This could be stocks, bonds, or other financial instruments. This could be a company, real estate, or even precious metals. Each type of investment has its own potential for growth and risk. As these investments grow, so does your money. Over time, the value of your investments can increase significantly, providing you with a substantial return. It's like earning money without actually working extra hours. Imagine being able to enjoy your life more, knowing that your investments are growing in the background. This is called passive income, and it's a key to building long-term wealth. Passive income allows you to earn money without having to actively work for it. Investing also helps you fight inflation. Inflation is the gradual increase in prices over time, which can erode the purchasing power of your money. Over time, things get more expensive. Everyday items like groceries, utilities, and other essentials can cost more, reducing what your money can buy. Your dollar today won't buy as much tomorrow. This is why it's crucial to invest, so your money can grow and keep up with rising costs. But investing helps your money grow faster than inflation, so your purchasing power stays strong. By making smart investment choices, you can ensure that your financial future remains secure and prosperous. Ready to start investing? It's easier than you think. First, you need a solid financial foundation. That means getting out of debt and building an emergency fund. Think of it like this. You wouldn't plant a tree in a hurricane, right? You need calm weather first. Once you're financially secure, you can start investing. A great place to begin is with a 401k or Roth IRA. These are retirement accounts that offer tax advantages, helping your money grow even faster. Remember, investing is a marathon, not a sprint. Start small and gradually increase your contributions. Even a little bit each month can make a big difference over time. Now, the fun part. Choosing your investments. Don't worry, it's not as complicated as it sounds. A good starting point is low-cost index funds. These funds pool money from many investors to buy a basket of stocks or bonds, giving you instant diversification. Diversification simply means spreading your money across different investments. This reduces your risk because if one investment does poorly, others can cushion the blow. Remember, investing involves risk. There's no guarantee you'll make money, and you could even lose some. But over the long term, the stock market has historically gone up. So be patient, stay invested, and ride out the ups and downs. Common questions. Simple answers. Feeling a little overwhelmed? That's okay. It's completely normal to feel a bit lost when you're starting out with investing. The world of finance can seem like a maze, but with a little guidance, you'll find your way. Investing can seem confusing at first. There are so many terms, strategies, and options that it can be hard to know where to begin. But don't worry, we're here to help. Here are answers to some common beginner questions that many new investors have. How much do I need to start investing? This is a question that almost every new investor asks. The good news is, you don't need a lot of money to get started. You can start with as little as $50 with some online platforms. This small amount can help you get your feet wet and start learning the ropes. The important thing is to start somewhere. Just like planting a tree, the sooner you start, the sooner you can enjoy the benefits. Even small investments can grow over time, thanks to the power of compound interest. When is the best time to invest? This is another common question. The best time to start was yesterday. The earlier you start, the more time your money has to grow. But don't worry if you haven't started yet. The second best time is today. It's never too late to start investing. The key is to take action and not procrastinate. The longer you wait, the more potential growth you might miss out on. Don't wait for the perfect moment. There will always be reasons to hesitate, but the perfect moment rarely comes. The best approach is to start now and learn as you go. What if I need my money back? This is a valid concern. Most investments have a degree of liquidity, meaning you can sell them and get your money back, minus any potential losses. It's important to understand the liquidity of your investments before you commit. This means that while you can access your money, the value might fluctuate. It's crucial to be aware of this and plan accordingly. Having a diversified portfolio can help manage this risk. Remember, there's no such thing as a stupid question. Everyone starts somewhere, and asking questions is a great way to learn. Don't be afraid to seek help and clarify your doubts. If you're unsure about something, ask a financial advisor. They can provide personalized advice based on your financial situation and goals. Or do your research. There are plenty of resources available, from books to online courses and seminars. Knowledge is power when it comes to investing. The more you know, the better decisions you can make. Don't be scared of the stock market. The stock market can seem scary with its constant ups and downs, but don't let fear keep you from investing. Remember, the stock market is like a roller coaster. It has its thrills and dips, but over time, it generally goes up. Instead of fearing the dips, see them as opportunities to buy more of your favorite investments at a discount. This is called buying the dip, and it can supercharge your long-term returns. Remember, investing is a long game. Don't panic sell when the market drops. Stay calm, stick to your plan, and watch your investments grow over time. Learn more, earn more. Investing is a journey of continuous learning. The more you know, the better equipped you'll be to make smart investment decisions. Luckily, there are tons of resources available to help you. Read books, listen to podcasts, and attend seminars. There are countless resources specifically designed for beginner investors. Don't be afraid to ask for help either. Talk to a financial advisor or a trusted friend who's knowledgeable about investing. Your future starts now. Investing is not just about growing your money. It's about building a brighter future for yourself and your loved ones. It's about achieving your financial goals, whether it's buying a house, retiring early, or leaving a legacy for your children. Every dollar you invest is a step towards a more secure and fulfilling future. So, don't wait another day. Start your investing journey today and watch your dreams turn into reality. Remember, the power to create a better future is in your hands. Start investing today and watch your money grow along with your dreams. Ready for the next step? Congratulations on taking the first step towards financial freedom. You've learned the basics of investing and you're ready to start growing your money. But this is just the beginning. In the next part of this series, we'll dive deeper into different investment strategies. We'll explore how to choose the right investments for your goals and risk tolerance. Get ready to take your investing knowledge to the next level. Don't miss out on the next exciting chapter in your investing journey. Stay tuned for part 2 of Investing for Beginners, where we'll unlock even more secrets to building lasting wealth.
Hey there,
Check
future
out-
millionaires. Investing might seem intimidating, like a club for Wall Street hotshots, but guess what? It's not. Investing is for everyone, and it's the key to growing your money. Before you dive in, you need to learn the lingo. Think of it like learning a new language, the language of money. Once you understand the basics, you'll be well on your way to building wealth. Don't worry, I'm here to break it down for you. We'll cover the essential terms every new investor needs to know. By the end of this guide, you'll be speaking the language of finance like a pro. Ready to get started? Let's do this. Just like any new skill, investing comes with its own set of terms and jargon. These terms might seem overwhelming at first, but they are the building blocks of your financial literacy. Understanding them is crucial to navigating the world of investments effectively. But don't let that scare you. Everyone starts somewhere, and with a bit of effort, you'll soon find these terms becoming second nature. Once you understand the language, everything else becomes much clearer. It's like having a map in a foreign city. Suddenly, you know where you're going and how to get there. Think of it like learning to cook. When you first start, the recipes might look like a foreign language, but with practice, you begin to understand the terms and techniques. You need to know what sauté or simmer means before you can whip up a delicious meal. Similarly, in investing, terms like diversification, equity, and yield are essential to creating a successful portfolio. The same goes for investing. Knowing these terms is like having the right ingredients and tools in your kitchen. Without them, you're just guessing and hoping for the best. Knowing the key terms helps you make smart decisions and cook up some serious wealth. It's about making informed choices that align with your financial goals. We're going to break down these terms into bite-sized pieces so you can easily digest them. Just like a good recipe, we'll take it step by step. Ready to expand your financial vocabulary? Let's get started. Remember, knowledge is power. The more you know, the better equipped you'll be to handle the ups and downs of the market. The more you understand these terms, the more confident you'll become in your investing journey. Confidence leads to better decisions, and better decisions lead to financial success. So, let's dive in and start speaking the language of money together. Ever wanted to own a piece of your favorite company? Imagine being more than just a customer, but an actual part owner of the brands you love and trust. That's what stocks are all about. Stocks represent ownership in a company, and owning them means you have a stake in the company's future. When you buy a stock, you're buying a small ownership stake in a company. This means you get to share in the company's profits and growth. Think of it like buying a slice of a giant pizza. Each slice represents a portion of the whole pizza, just like each stock represents a portion of the company. The more slices you own, the bigger your share of the pizza and the profits. Owning more stocks means you have a larger claim on the company's earnings. Companies sell stocks to raise money for things like expanding their business or developing new products. This capital helps them grow and innovate. As a stockholder, you become a part owner and share in their success. You might even receive dividends, which are a portion of the company's profits paid out to shareholders. Of course, just like any business, companies can have good times and tough times. The stock market can be unpredictable and the value of your stock can fluctuate. The value of your stock can go up or down depending on how well the company is doing. It's important to stay informed and understand the risks involved in investing. Investing in stocks requires research and a good understanding of the market. It's not just about buying and selling, it's about making informed decisions. Many investors use tools and resources to track their investments and make strategic choices. This can include financial news, stock analysis, and advice from financial advisors. By staying informed and making smart decisions, you can increase your chances of success in the stock market. Remember, investing is a long-term journey, not a get-rich-quick scheme. So whether you're a seasoned investor or just starting out, owning a slice of something big can be an exciting and rewarding experience. Happy investing. Bonds are a bit different from stocks. Instead of owning a piece of a company, you're lending money to a company or government. Think of it like giving your friend a loan. They promise to pay you back the money with interest. That interest is your reward for lending the money. Bonds are generally considered less risky than stocks. That's because you're more likely to get your money back, even if the company or government isn't doing so well. However, because bonds are less risky, they also tend to offer lower returns compared to stocks. It's all about finding the right balance between risk and reward. Diversification. Don't put all your eggs in one basket. You've probably heard the saying, don't put all your eggs in one basket. This age-old advice is not just for farmers or those handling fragile items, it holds significant wisdom for investors as well. Well, the same goes for investing. When it comes to managing your finances, putting all your money into a single investment can be incredibly risky. Diversification means spreading your money across different types of investments, like stocks, bonds, and real estate. By doing so, you are not overly reliant on the performance of one particular asset, bonds, and real estate. Each type of investment has its own set of risks and rewards, and by combining them, you can create a more balanced and stable portfolio. This helps reduce your risk. Diversification acts as a buffer against the volatility of the market, ensuring that your financial future is not tied to the fate of a single investment. Think about it. If all your money is invested in one company's stock and that company goes bankrupt, you could lose everything. This scenario is a nightmare for any investor, but it can be avoided with proper diversification. But if you have a diversified portfolio, even if one investment performs poorly, the others can help cushion the blow. This way, the impact of a single underperforming asset is minimized. Diversification is like having a safety net for your investments. It provides a layer of security that can help you sleep better at night, knowing that your financial future is more secure. It helps you weather the ups and downs of the market and come out ahead in the long run. Over time, a well-diversified portfolio can lead to more consistent and reliable returns, helping you achieve your financial goals. Remember, the key to successful investing is not just about picking the right stocks or bonds, but also about managing risk through diversification. By spreading your investments, you are better positioned to handle market fluctuations and unexpected events. Whether you're saving for retirement, a child's education, or a dream vacation, diversification can help you reach your financial milestones with greater confidence and peace of mind. So the next time you think about investing, remember the wisdom of not putting all your eggs in one basket. Diversify your investments and build a more resilient financial future. Risk tolerance. How much can you handle? Risk tolerance refers to how much risk you're comfortable taking with your investments. Are you a daredevil who loves the thrill of a roller coaster? Or do you prefer a leisurely stroll in the park? Your risk tolerance will determine what types of investments are right for you. If you're someone who can stomach big swings in the market, you might be comfortable with riskier investments like growth stocks. But if you prefer a smoother ride, you might opt for more conservative investments like bonds. There's no right or wrong answer. It's all about finding what aligns with your personal risk appetite. Return on investment, ROI. Your scorecard for success. Return on investment, or ROI, is how you measure the profitability of your investments. It tells you how much money you've made or lost on an investment relative to the amount you invested. Think of it like your scorecard in a game. A higher ROI means you're winning. For example, if you invest $1,000 and your investment grows to $1,100, your ROI is 10%. That means you made a 10% profit on your initial investment. Not bad. Compound interest, the snowball effect. Compound interest is like the magic of investing. It's the process of earning interest on your interest, which can lead to exponential growth over time. Think of it like a snowball rolling down a hill. As it rolls, it picks up more snow and gets bigger and bigger. That's compound interest at work. The earlier you start investing, the more time your money has to compound. Even small amounts invested consistently can grow into a significant nest egg over time thanks to the power of compounding. Remember, time is your best friend when it comes to investing. Time horizon. Patience is a virtue in investing. Time horizon refers to how long you plan to keep your money invested. Are you saving for a down payment on a house in a few years, or are you investing for retirement decades from now? Your time horizon will influence your investment strategy. If you have a long time horizon, you can afford to take on more risk because you have more time to recover from any potential losses. But if you have a short time horizon, you'll want to be more conservative with your investments because you have less time to make up for any losses. Inflation, the silent thief. Inflation is like a sneaky thief that slowly eats away at the value of your money over time. It means that the same amount of money buys you less goods and services in the future. Think about how much a gallon of milk cost 10 years ago compared to today. That's inflation at work. As an investor, you need to make sure your investments are growing at a rate that outpaces inflation. Otherwise, you're actually losing purchasing power over time. Take control of your financial future. There you have it, folks. You've just learned some of the most important investment terms. Now it's time to put that knowledge into action. Don't wait another minute to start investing in your future. The sooner you begin, the more time your money has to grow. Remember, investing isn't just about getting rich quick. It's about building a secure financial future for yourself and your loved ones. Ready to take the next step? Head over to our first guide in this series for a beginner-friendly introduction to the world of investing. Keep learning, keep growing. Congratulations on taking this important step towards financial literacy. Remember, learning about investing is an ongoing journey. The more you learn, the more confident and informed you'll become as an investor. So keep reading, keep asking questions, and never stop learning. Investing can be incredibly rewarding, both financially and personally. It empowers you to take control of your financial future and create the life you've always dreamed of. Now go out there and
The thrill of the hunt, your path to stock market riches. Are you ready to unlock the incredible wealth-building potential of the stock market? Picking the right stocks is the key to unlocking life-changing returns. This isn't about gambling or chasing get-rich-quick schemes. It's about becoming a savvy investor, one who understands the fundamentals of the market. Get ready to take control of your financial destiny. But before we get started, smash that like button and click on that subscribe button. Comment below what topic you would like me to cover next. Unlocking value. Why picking the right stocks is key. Picking the right stocks isn't just about making money, it's about building lasting wealth. When you invest in a company, you're essentially buying a piece of its future. Choose wisely, and you'll ride the wave of their success. By digging deep into a company's financials, you can make informed decisions. Get ready to unlock the secrets of successful stock picking. Unveiling the toolkit, your arsenal for stock market success. Knowledge is power, and in the world of stock investing, the right knowledge can be incredibly lucrative. Think of stock market research as detective work. We need our own set of tools to unravel the mysteries of the stock market. Ready to become a stock market detective? Let's go. Diving deep, understanding fundamental analysis. This approach is all about understanding the intrinsic value of a company. We dig deep into a company's financial statements, scrutinizing its revenue, profits, debt, and assets. By analyzing key financial ratios and metrics, we can gain valuable insights into a company's profitability and growth potential. This approach is particularly important for long-term investors. Stay tuned. Charting the course. The power of technical analysis. Technical analysis is all about studying price movements and identifying patterns in the market. We study historical price charts, looking for trends and indicators that can help us predict future price movements. This approach is based on the belief that history often repeats itself in the market. By identifying recurring patterns, we can anticipate future price movements. Technical analysis is popular among short-term traders. Stay tuned. Cracking the code deciphering financial statements. Financial statements provide a snapshot of a company's financial health. There are three main financial statements: the income statement, the balance sheet, and the cash flow statement. The income statement tells us how much revenue a company generated and the expenses it incurred. The balance sheet is a snapshot of a company's assets, liabilities, and shareholder equity. The cash flow statement tracks the movement of cash in and out of a company. Understanding these statements is crucial. Ratio revolution, unlocking key insights into company performance. Financial ratios allow us to zoom in on specific aspects of a company's financial performance. Profitability ratios tell us how much profit a company generates for every dollar of revenue. Liquidity ratios measure a company's ability to meet its short-term obligations. Solvency ratios assess a company's long-term financial health. Efficiency ratios measure how efficiently a company is using its assets to generate sales. Spotting red flags, warning signs to watch out for. Investing in the stock market isn't just about finding shining stars, it's also about avoiding potential landmines. Keep an eye out for red flags that could signal trouble ahead. One major red flag is a consistent decline in revenue or profits. Another red flag is a sudden surge in debt. Watch out for companies with consistently negative cash flow from operations. Pay close attention to inventory levels. Beyond the numbers. Uncovering a company's competitive edge. To truly understand a company's potential, we need to look beyond the balance sheet and uncover its competitive advantage. A company's competitive edge can manifest in various ways. In the world of investing, we often refer to a company's competitive advantage as its moat. A strong competitive advantage protects a company from competition. Get ready to sharpen your analytical skills and unlock the secrets of a long-term investment success. Moats and market share. Assessing industry dominance. One of the most telling indicators of a company's competitive strength is its market share. A company with a large market share generally indicates a dominant position in its industry, but market share alone doesn't tell the whole story. We also need to consider the size and growth potential of the overall market. Understanding a company's competitive positioning within its industry is crucial for assessing its long-term prospects. The innovation factor, identifying companies built for the future. In today's rapidly evolving business landscape, innovation is no longer optional. It's essential for survival. Companies that rest on their laurels, content with their current products and services, risk being disrupted by agile newcomers with fresh ideas and a finger on the pulse of changing consumer preferences. When assessing a company's competitive advantage, pay close attention to its innovation track record. Does the company have a history of developing new products or services? Does it invest heavily in research and development? Is it at the forefront of emerging trends and technologies within its industry? Companies that prioritize innovation are more likely to adapt to changing market conditions, meet evolving customer demands, and stay ahead of the competition. They're the ones constantly pushing the boundaries, exploring new frontiers, and creating the products and services of tomorrow. Look for companies with a culture of innovation, a pipeline of promising new products or services, and a management team that embraces change and encourages creativity. These companies are more likely to be the disruptors, not the disrupted, positioning themselves for long-term growth and success. Remember, investing is not just about identifying companies that are performing well today, it's about finding companies that are well positioned for continued success in the years to come. Innovation is a key driver of that future success, so prioritize companies that make it a core part of their DNA. The leaders of the pack. Why management matters. Welcome back, savvy investors. We've covered a lot of ground in our quest to master stock picking. We've delved into the nitty-gritty of financial statements, explored the dynamics of competitive advantage, and learned how to spot companies with the potential for long-term success. But there's one crucial piece of the puzzle we haven't yet addressed. The people at the helm, the management team. Think of it like this. Even the most promising ship needs a skilled captain and a competent crew to navigate treacherous waters and reach its destination. Similarly, even a company with a fantastic product, a loyal customer base, and a rock-solid balance sheet can flounder under the guidance of ineffective leadership. A company's management team is responsible for setting its strategic direction, making key operational decisions, and allocating capital wisely. They're the ones who translate a company's vision into reality, guiding it through challenges and capitalizing on opportunities. Investing in a company with a strong management team is like having a team of experienced Sherpas guiding you up Mount Everest. They know the terrain, they anticipate obstacles, and that they're committed to reaching the summit. In the following sections, we'll explore how to evaluate the quality of a company's management team, delving into their track record, their leadership style, and their alignment with shareholder interests. Get ready to meet the people behind the numbers and make more informed investment decisions. Reading between the lines, assessing management quality. Now that we understand the crucial role management plays in a company's success, let's explore how to assess their quality. Unfortunately, there's no magic formula or standardized test to determine management effectiveness. It requires a bit of detective work, reading between the lines, and piecing together clues from various sources. One of the best places to start is the company's annual report, particularly the management's discussion and analysis section. This section provides valuable insights into the thought process behind management's decisions, their assessment of the company's current performance, and their outlook for the future. Pay close attention to the tone and language used by management. Do they sound confident and optimistic about the company's prospects, or do they seem evasive and hesitant to make concrete statements? Are they transparent about challenges and risks, or do they try to sugarcoat bad news? Next, delve into the backgrounds and experience of key executives. Look for individuals with a proven track record of success in their respective fields. Have they held leadership positions at other successful companies? Do they possess relevant industry expertise? Examine how long the current management team has been in place. A stable and experienced leadership team can be a sign of strength, while frequent turnover at the top could signal internal turmoil or a lack of clear direction. Don't hesitate to look beyond the company's official publications. Search for interviews, articles, and conference presentations featuring members of the management team. These sources can provide valuable insights into their leadership style, their communication skills, and their overall vision for the company. Skin in the game. Aligning your interests with company leadership. Assess management's alignment with shareholder interests. As an investor, you want the leadership to look out for your best interests. Insider ownership is a key indicator of alignment. Management with skin in the game has a powerful incentive to benefit all shareholders. Look for significant management ownership. Consider executive compensation and long-term incentives. Be wary of lavish salaries when the company underperforms. Pay attention to corporate governance practices. Ensure a diverse and independent board. Strong governance ensures management accountability. Congratulations, astute investors. You've now journeyed deep into the heart of stock picking, armed with the knowledge to analyze financial statements, assess competitive landscapes, and evaluate management teams. But the journey doesn't end there. The stock market is like a living, breathing entity, constantly evolving, reacting to news and throwing curveballs your way. To truly master stock picking, you need to become a news junkie, constantly monitoring the financial landscape for events and trends that could impact your investments. Think of it like being a savvy sailor, always attentive to the wind, the tides, and the occasional storm brewing on the horizon. Staying updated doesn't mean becoming glued to a ticker tape, obsessively tracking every minute fluctuation. Instead, focus on understanding the bigger picture, the macroeconomic trends, industry shifts, and company-specific news that can significantly influence stock prices. What moves the market? Interest rate hikes by the Federal Reserve, inflation reports, geopolitical events, technological breakthroughs, changes in consumer behavior. These are just a few examples of the forces that can send ripples through the stock market, affecting even the most well-established companies. In the upcoming sections, we'll explore how to effectively filter the overwhelming deluge of financial news, identifying reliable sources of information and developing a news consumption strategy that works for you. Get ready to sharpen your news-gathering skills and become a more informed, confident investor. In today's digital age, we're bombarded with information from all sides. The financial news landscape is no exception. This abundance of information can be overwhelming. Your goal is to identify reliable, trustworthy sources. Think of it like building a team of trusted advisors. Start with reputable financial news organizations. Look for publications with a long history of accuracy. Don't be afraid to diversify your news sources. Seek out perspectives from a variety of experts. This helps you gain a well-rounded understanding. Be wary of social media as a primary source. Verify information from multiple sources. Not all financial news is created equal. Develop a discerning eye for quality information. Congratulations on making it to the final section of our stock picking adventure. You've learned how to analyze companies, assess industries, and evaluate management teams. Remember, investing is a journey, not a destination. The market is constantly evolving, and the most successful investors are lifelong learners. Even the most experienced surfer never stops learning about the ocean. They study wave patterns and adapt their techniques. Similarly, as an investor, your education is never truly complete. Make a commitment to continuous learning. Read books, attend seminars, and follow reputable financial blogs. The more you learn, the better equipped you'll be to navigate the market. Don't be afraid to experiment and make mistakes. Investing is a learning process, and valuable lessons come from our missteps. Treat each investment as an opportunity to learn and grow. Seek out mentors and connect with other investors. Surround yourself with people who share your passion for investing. Join investment clubs, attend industry events, and engage in online forums. Remember, investing is a marathon, not a sprint. Embrace a mindset of continuous learning to weather market storms. Now, put your newfound knowledge into action. Start researching companies and identifying investment opportunities. The stock market offers incredible wealth-building potential for those who dare to learn, adapt, and invest wisely. You've now got the essential tools and knowledge to research stocks like a pro. Remember, investing in the stock market is a marathon, not a sprint. It's about making informed decisions, staying disciplined, and focusing on the long term. Don't be afraid to get started. The best way to learn is by doing. Pick a company that interests you, put your newfound research skills to the test, and see what you discover.
Do you dream of financial freedom? Do you wish your money could work harder for you? It's time to stop dreaming and start investing. This is your guide to understanding the exciting world of ETFs, index funds, and mutual funds. We're going to break down these investment vehicles in a way that's easy to understand and even easier to act on. Don't forget to check out the other parts of this series to become a true investing pro. But remember, this is just the beginning of your journey to financial empowerment. Let's dive in. Welcome to the wonderful world of ETFs, where investing becomes both exciting and accessible. ETFs, or exchange-traded funds, are like baskets of stocks. Imagine having a basket that contains shares from multiple companies, all bundled together. They let you invest in a variety of companies with just one purchase. This means you can diversify your investment portfolio without having to buy each stock individually. Imagine owning a tiny piece of hundreds of companies all at once. This not only spreads your risk, but also opens up opportunities across different sectors. That's the power of ETFs. They offer a simple way to gain exposure to a broad market or specific industry. They trade on stock exchanges, just like individual stocks. This means you can buy and sell them throughout the trading day, taking advantage of market movements. Unlike mutual funds, which are priced at the end of the day, ETFs offer real-time pricing. ETFs are known for their flexibility and low costs. They often have lower expense ratios compared to mutual funds, making them a cost-effective choice for many investors. They're a great option for both beginner and seasoned investors. Whether you're just starting out or looking to diversify an existing portfolio, ETFs can be a valuable tool. Whether you're interested in tech giants or renewable energy, there's an ETF out there for you. There are ETFs for almost every sector and investment theme you can think of. Ready to explore the world of ETFs? The possibilities are endless, and the potential for growth is significant. Stay tuned, because next up, we're diving into the world of index funds. We'll explore how they work and why they might be a good fit for your investment strategy. Index funds, your ticket to steady growth. Imagine a world where your investments grow steadily over time without the need for constant monitoring or complex strategies. That's the promise of index funds. Index funds are like ETFs, but with a twist. While both are designed to track the performance of a specific market index funds are often more straightforward and easier to manage. They are designed to replicate the performance of a particular index, providing a simple and effective way to invest in the market. They aim to track a specific market index, such as the S&P 500. This index includes 500 of the largest companies in the US, offering a broad snapshot of the market's performance. By investing in an index fund that tracks the S&P 500, you are essentially investing in a piece of each of these companies. This means that when the index goes up, your investment goes up too. It's a simple yet powerful way to grow your wealth over time. The beauty of index funds lies in their ability to mirror the market's performance, providing steady growth with minimal effort. Index funds are known for their simplicity and low fees, making them a favorite among investors seeking steady, long-term growth. The low fees are a significant advantage, as they allow more of your money to stay invested and grow over time. This cost efficiency is one of the key reasons why index funds are so popular. Think of index funds as autopilot for your investments. Once you set up your investment, there's no need for constant adjustments or active management. The fund automatically adjusts to match the performance of the index, allowing you to sit back and watch your investment grow. They offer a hands-off approach while still providing exposure to a diversified portfolio. Diversification is a crucial aspect of investing, as it helps spread risk across different assets. With index funds, you get instant diversification, reducing the impact of any single investment's poor performance on your overall portfolio. Whether you're just starting or a seasoned investor, index funds are a solid choice. They provide a reliable and straightforward way to build wealth over time. But wait, there's more. Index funds are not just for beginners. They are also a valuable tool for experienced investors looking to maintain a balanced and diversified portfolio. Let's uncover the world of mutual funds and how they can help you achieve your financial goals. Mutual funds offer another avenue for diversification and growth, with professional management and a wide range of investment options. Stay tuned as we explore how mutual funds can complement your investment strategy and help you reach your financial objectives. Mutual funds. Let the experts handle it. Mutual funds are another way to diversify your investments. They pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. The fund is managed by a professional fund manager who makes investment decisions on behalf of the investors. Mutual funds offer a wide range of investment options, from conservative to aggressive. They're a great option for investors who prefer to leave the stock picking to the pros. Now that you know the basics of ETFs, index funds, and mutual funds, let's see how these investment vehicles can work in the real world. Sarah's success story, from doubt to dividends. Meet Sarah, a young professional who was intimidated by the stock market. She had always heard stories of people losing their savings and was afraid to take the plunge. She always thought investing was too complicated and risky. The jargon, the charts, the constant market fluctuations, it all seemed overwhelming. But then, Sarah discovered the power of ETFs, or exchange-traded funds. She read articles, watched videos, and slowly began to understand how they worked. She started small, investing a portion of her savings every month. It wasn't much, but it was a start. She used a user-friendly app that made the process simple and straightforward. Over time, Sarah watched her investments grow. She saw the value of her portfolio increase, and it gave her a sense of accomplishment and security. She learned about different sectors and investment strategies. She read books, attended online courses, and even joined investment forums to discuss ideas with others. The more she learned, the more confident she became. She started to diversify her investments, spreading her money across different sectors to minimize risk. Today, Sarah is a savvy investor, and her portfolio is a testament to the power of consistent investing. She has a well-balanced portfolio that includes stocks, bonds, and ETFs. Sarah's story is just one example of how investing can transform your financial future. She went from being a novice to a knowledgeable investor, and her journey is an inspiration to many. Are you ready to start your own investment journey? With the right knowledge and tools, you too can go from doubt to dividends. Take the first step today and secure your financial future. Choosing your investment champion. Now that you understand the basics of ETFs, index funds, and mutual funds, it's time to choose the right investment for you. Consider your investment goals, risk tolerance, and time horizon. Do you prefer a hands-on or hands-off approach? Are you investing for retirement or a down payment on a house? There's no one-size-fits-all answer, but by understanding your personal circumstances and the different investment options available, you can make informed decisions that align with your financial aspirations. But remember, diversification is key. Let's explore why you shouldn't put all your eggs in one basket. Diversification. Don't put all your eggs in one basket. Imagine putting all your money into a single stock. What happens if that company faces unexpected challenges? Your entire investment could be at risk. That's where diversification comes in. By spreading your investments across different asset classes, sectors, and geographies, you can reduce your overall risk. Think of diversification as building a strong and stable investment portfolio. Just like a house needs a solid foundation, your portfolio needs a mix of investments to weather market fluctuations. But how do you determine the right level of risk for your investments? Let's find out. Risk versus reward. Finding your comfort zone. Investing always involves some level of risk. Generally, the higher the potential return, the higher the risk. Conversely, lower-risk investments typically offer more modest returns. It's essential to find the right balance between risk and reward that aligns with your financial goals and comfort level. If you're risk-averse, you might prefer to invest in more conservative options like bonds or index funds. If you're comfortable with higher risk, you might consider growth stocks or emerging markets. Remember, investing is a marathon, not a sprint. Let's explore the power of long-term investing. The power of long-term investing. Time is your greatest ally when it comes to investing. The longer you stay invested, the more time your money has to grow. This is due to the power of compounding, where your earnings generate even more earnings over time. Think of it like a snowball rolling downhill. It starts small, but as it gathers more snow, it grows larger and larger. The same principle applies to investing. Ready to take the first step towards financial freedom? Let's get started. Getting started. Your first steps to financial freedom. Opening an investment account is easier than you might think. Many online platforms offer user-friendly interfaces and helpful resources. Once you've opened an account, you can start investing with as little as a few dollars. Remember, the key is to start small and stay consistent. Even if you can only invest a small amount each month, it will add up over time. Don't wait another moment to start building the future you deserve.
Ever wonder how some people seem to grow their wealth effortlessly? It's like they have a magic money multiplier, right? Well, in a way they do. It's called compounding interest. And it's the closest thing to financial magic you'll find. This isn't about getting rich quick schemes. It's about making your money work harder for you so you can achieve your financial goals. Imagine a snowball rolling down a hill. It starts small, but as it picks up snow, it grows bigger and bigger, gaining momentum. That's compounding in action. Just like that snowball, your money can grow exponentially over time. The best part, you don't need to be a Wall Street whiz to unlock this magic. Whether you're starting with a little or a lot, understanding compounding is key to building lasting wealth. So buckle up, because we're about to break down this powerful concept into bite-sized pieces. Get ready to watch your financial future transform. Before we get started, if you could hit the like and subscribe button, it really helps the algorithm push out this important information. Also, comment below what you want to see next. Imagine this: you invest just $100 today. With the power of compounding, that small investment could be worth significantly more in the future. How much more? Well, that depends on how long you let it grow and the interest rate it earns. Think of it like planting a tree. The sooner you plant it, the more time it has to grow into a mighty oak. The same goes for your investments. The earlier you start, the more time your money has to compound and flourish. Don't let another day go by without harnessing the incredible power of compounding. This isn't about waiting for a windfall or winning the lottery. It's about taking control of your finances and creating a brighter future. In this video, we'll unlock the secrets of compounding interest and show you how to make it work for you. We'll explore the math behind it, share inspiring stories, and give you actionable steps to start building your own snowball of wealth. Are you ready to get excited about your financial future? Let's dive in. Let's break down compound interest. It's like earning interest on your interest. Imagine you put $100 in a savings account with 5% interest. After 1 year, you earn $5, making it $105. In year 2, you earn interest on $105. Your interest earns interest and your money grows faster. The longer you let it compound, the more dramatic the results. Let's say you spend $5 on a fancy coffee every day. That's $150 a month. Now, imagine if you invested that $150 monthly, earning a 7% annual return. Over 30 years, you wouldn't believe how much that seemingly small investment could grow to. We're talking about potentially hundreds of thousands of dollars. This is the power of compounding in action. By consistently investing a small amount, you're allowing your money to work its magic over time. Think about it. Skipping that daily latte could be your ticket to financial freedom. It's all about making smart choices today that will benefit your future self. Compounding isn't about depriving yourself. It's about making your money work as hard as you do. But here's the real kicker. The earlier you start, the more time your money has to grow. Let's talk about why time is your secret weapon when it comes to building wealth. Time, your secret weapon. Time is your best friend when it comes to compounding. The sooner you start investing, the more time your money has to grow exponentially. Early years of compounding are crucial. Your money works hardest, generating more interest on itself. It's never too late to start investing. Even small, consistent investments can lead to significant wealth. Ready for a cool trick? It's called the Rule of 72, and it helps you estimate how long it takes for your money to double with compounding. Just divide 72 by the interest rate you expect to earn. For example, if you invest at 7%, it'll take roughly 10 years for your money to double. That's the magic of compounding. Now, imagine that happening again and again over decades. Your initial investment can multiply many times over. It's like a snowball turning into an avalanche of wealth. Remember, this is just an estimate, but it illustrates how powerful compounding can be. The higher the interest rate, the faster your money grows. That's why it's important to explore different investment options and find what aligns with your goals and risk tolerance. Let's dive deeper into how compounding accelerates your wealth-building journey. It's all about the snowball effect in action. Think about this. If your money doubles every 10 years, in 20 years, it doesn't just double again, it quadruples. That's the beauty of exponential growth. Compounding doesn't just add to your wealth, it multiplies it over time. This is why starting early is so crucial. The earlier you start, the more time your money has to double and redouble itself. Those early years of compounding are like rocket fuel for your finances. Remember that snowball rolling down the hill? With compounding, it's like that snowball is picking up speed and size as it goes, creating an unstoppable force. It's not about getting rich quickly, it's about making smart choices today that will pay off exponentially in the future. So how do you harness this power? It all starts with consistency. The most important ingredient in the compounding recipe is consistency. Just like you can't build a skyscraper overnight, you can't expect to get rich quick with compounding. It takes time and consistent effort. Think of it like working out. You don't see results after one workout, but over time, with consistent effort, you'll start seeing amazing changes. The same goes for your finances. By consistently investing, even small amounts, you're building a solid foundation for future wealth. It's not about making a huge one-time investment, it's about developing good financial habits and sticking to them. Whether you're investing in the stock market, real estate, or a business, the key is to keep adding to your investments and let them compound over time. Remember, even small, consistent actions can lead to extraordinary results in the long run. So are you ready to put the power of compounding to work for you? Stay tuned, because in the next section we'll share inspiring stories of people who've used compounding to achieve their financial dreams. Meet Sarah, a young professional who, like many of us, enjoyed her daily latte a little too much. She realized she was spending close to $200 a month on fancy coffees, money that could be put to better use. So, Sarah made a choice. She decided to cut back on her coffee habit and invest that $200 monthly into a low-cost index fund. At first, it felt like a small change, but Sarah knew that consistency was key. Years passed, and Sarah diligently continued her monthly investments, watching her portfolio grow steadily. Then something amazing happened. Thanks to the power of compounding, her initial investments had multiplied significantly. Sarah was able to use her returns to make a down payment on her dream condo. David, a college student working part-time, understood the importance of starting early. He'd heard about compounding and decided to put it to the test. Even though he could only spare $50 a month, David began investing in a Roth IRA. His friends thought he was crazy, but David knew time was on his side. Fast forward a few decades, and David's early decision paid off handsomely. While his friends were just starting to think about retirement, David had built a substantial nest egg. He was able to retire comfortably, travel the world, and pursue his passions, all thanks to the magic of compounding. The gift that keeps on giving generational wealth. Imagine leaving a legacy that empowers generations to come. That's the power of compounding when it comes to building generational wealth. Take the story of the grandparents who invested a small amount of money in a trust fund for their newborn granddaughter. That small investment, compounded over decades, grew into a significant sum. By the time their granddaughter was ready for college, the trust fund had grown enough to cover her entire tuition and more. This is the incredible impact of compounding. It's not just about building your own wealth, it's about creating a brighter future for your loved ones. Imagine the possibilities: a college fund for your children, a down payment on a home for future generations, or even a charitable foundation that makes a difference in the world. Start today, not tomorrow. You've seen the power of compounding, the inspiring stories, and now it's time to take action. The first step: start today. Don't wait for the perfect time or until you have a huge chunk of money. Remember, even small amounts invested consistently can snowball into significant wealth over time. The sooner you plant that financial seed, the more time it has to grow. Think about it. If you invest just $50 a week, that's over $2,600 a year. Now, imagine that money working its magic with compounding over 10, 20, or even 30 years. The results can be life-changing. So what are you waiting for? Start small, start today, and watch your financial future transform. Now that you're ready to start, let's talk about where to put your money to work. There are countless investment options out there, but remember, it's not about getting rich quick. It's about making smart, long-term investments. Consider low-cost index funds, which allow you to invest in a diversified portfolio of stocks with low fees. This is a great option for beginners and experienced investors alike. Another option is real estate. Investing in rental properties or even your own home can be a powerful way to build wealth through appreciation and rental income. Remember to do your research. Consider your risk tolerance and don't be afraid to seek guidance from a financial advisor if needed. The key is to invest wisely and let your money work its magic over time. Investing is a marathon, not a sprint. There will be ups and downs in the market, but the most important thing is to stay the course and stay consistent. Don't panic sell when the market dips. Remember, you're in it for the long haul. In fact, market downturns can be opportunities to buy low and watch your investments rebound even stronger. Review your investments periodically, rebalance your portfolio as needed, and stay informed about market trends. But most importantly, stick to your plan and trust in the power of compounding. Remember, time is your greatest ally. The longer you stay invested, the more your money will grow exponentially. So, be patient, be consistent, and watch your financial dreams become a reality. Congratulations, you've unlocked the secret to building lasting wealth, the magic of compounding interest. Remember that snowball? You've started rolling it, and now it's time to watch it gather momentum and grow into an avalanche of financial freedom. We've covered a lot of ground, from the basic principles of compounding to inspiring stories of people who've used it to achieve their dreams. But knowledge without action is like a car without an engine. It won't get you very far. Remember Sarah, who traded her daily coffee for a condo, or David, who started investing in college and retired early. Their stories are proof that compounding isn't just a theory, it's a powerful tool that can transform your life. Now, it's your turn. Take that first step today. Start small, invest consistently, and watch your money grow exponentially over time. Don't let fear, procrastination, or the perfect moment hold you back. The perfect moment is now. Remember, you don't need to be a financial expert to make compounding work for you. Start with what you've learned today. Continue to educate yourself, and don't be afraid to seek guidance from a financial advisor if needed. The most important thing is to take action. Start building that snowball of wealth today, and watch as it transforms your financial future. And hey, while you're at it, why not share this video with a friend who could use a little financial inspiration? Don't forget to like, subscribe, and hit that notification bell so you don't miss out on more tips and tricks to unlock your financial potential. Until next time, keep learning, keep growing, and keep building that wealth.